welcome to Macros with Maithili, the ET Now show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. This week we're going to take a hard look at an impending development that's already spooked markets across the world, a possible hike in the Fed rate. And joining me in the discussion to try and make sense of not just the Fed's mumbo-jumbo, but also the conflicting global economic cues are two very special guests. Ishwar Prasad, Senior Fellow at Brookings, Washington, and Rakesh Mohan, former Deputy Governor, Reserve Bank of India, and presently visiting faculty at Yale, Connecticut, US. Welcome to the show, Ishwar, Rakesh. Let me start by asking each of you in turn something that's puzzled me for long now. What is the US Fed really looking for? Since all the macro data can never be entirely unambiguous, it's hard to get away from the feeling that for all its claims about being data dependent, the Fed is really looking for excuses not to raise interest rates because it fears the consequences of a rate hike. Let me start with you, Ishwar. As a long Fed watcher, maybe you can dispel some of that mystery.
It's a very complicated situation for the Fed, Maithili, because the objective that they have as part of their mandate, of course, is based on inflation. The inflation data don't suggest they should be moving, but on the other hand, the labor market does seem to be doing quite well, although last month's jobs growth numbers were not as strong as in previous months. The unemployment rate is still hovering around 4.9%, and wage pressures are very gradually beginning to pick up. The difficulty the Fed faces is that it's still a very uncertain environment in the US because investment growth is low, productivity growth is low, and there is a lot of potential uncertainty from the rest of the world, especially from fallout effects from Brexit that could still be working their way through, what happens with China growth. So the Fed, I think, is really in a very difficult spot whether it wants to get ahead of inflation, even though there are no signs of inflation out there. So I think it's a genuine conundrum for the Fed. It's not that they're trying to confuse or play with markets. I think there is a very strong division of opinion among the Federal Open Market Committee members about what to do right now.
Rakesh, would you agree with Ishwar's assessment?
Maithili, as you can imagine, you clearly posed a very difficult question. Since the crisis broke in 2008, we have had 8 years now of very low interest rates in the US, in Europe, in Japan, and many other parts of the world. The question that is indeed which is being given a great deal of thought in the United States and elsewhere is how long is this low interest regime going to last? And there are indeed lots of discussions taking place in terms of the future of monetary policy frameworks in the world and what exactly can be done in the short term. So very clearly the US Fed has indeed a very difficult task ahead of them. The intention of the US Fed was perhaps made relatively clear last December when they did do the first raising of interest rates in December of 2015. When essentially the signal was that as the US economy does recover, as unemployment comes down, and there are clear signs of inflation reaching the inflation target of 2%, that as they get greater confidence in inflation actually reaching their target of 2% in the next couple of years or next year or two, that would be a good signal for raising interest rates, both from the point of view that if the US economy is at full employment, as the mandate requires them to observe and as one of their objectives, and as the inflation goes towards the 2% target, that is when they should start raising interest rates. So they did that last December, that is December 2015. Now, since then, of course, there has been speculation before every meeting on whether they were going to continue with the kind of forward guidance that had been given in the December 2015 meeting. Now, as it has happened, they have indeed not raised rates again since December 2015, and they're still waiting for data. The question now is that in the statements that have come out of the US Fed, both from the chair as well as from other governors, other observers in the United States, that there's a reasonable degree of doubt on the inflation rate reaching 2% even over the next 15, 18, 24 months. So there is, so in their own language, in a sense, they do not yet have the confidence that the rate of inflation will reach their target of 2% in the relevant time frame for the future. On the employment side, that even though unemployment levels have indeed come down to around 5%, which is usually regarded as the full employment rate in the United States, now there is something that maybe some things have changed. First of all, the labor force participation rate is still low. So in that sense, the employment, there's still some way for employment gains to continue without any pressure on inflation. So that's sort of the situation that the US Federal Reserve is in terms of deciding when and if to give a signal again that they're going to start to continue the upward cycle of monetary policy normalization towards somewhat higher interest rate regime.
To be sure, Ishwar, asset prices are not driven only by monetary policy, but at this juncture, asset prices are clearly being driven by liquidity. So can the Fed disown responsibility for the run-up in stock prices that we're seeing not only in the US but in markets across the world? The Dow Jones is up and our own Sensex touched an all-time 18-month high last week before fears of Fed action saw some correction.
No, there is legitimacy to the argument that you just made, Maithili, because after all the evidence suggests that the quantitative easing operations of the Fed have had a positive effect on financial markets through stock markets, what is happening in a broader range of asset classes as well. And the hope was that that would feed into real economic activity. So that is not the standard transmission channel for monetary policy. So the Fed and other big central banks around the world are relying on this asset market channel, which creates a lot of risks. One question is whether an increase of, say, 25 or even 50 basis points by the Fed would really change that dynamic completely, because this is a very low interest rate environment still in the US and around the world. And given the search for yield, I think we are going to have money going into these asset markets, especially equity markets. So trying to douse the rally in the stock markets, I think makes sense at some level, but the risk again is that you end up not getting the real economy, especially investment growth, perking up. Now, what the Fed has said, and I think it's really the right answer, is that ultimately monetary policy cannot do the things on the real side of the economy. We've heard this in India as well, that it's not monetary policy, but other broader structural policies that need to take up the slack. Right now, there is a crisis of confidence which is holding back investment and therefore productivity growth as well. So given how fragile both business and consumer confidence are at this stage, that's another thing the Fed has to worry about, whether by signaling that it is going to start raising interest rates and move aggressively on that front, it chokes off confidence as well. So again, an extraordinarily difficult balancing act, and I think it's very difficult to figure out what the right path is at this stage.
But Ishwar, if investment is not happening because of a crisis of confidence, then there's all the more reason for the Fed to be agnostic about interest rates and go ahead and hike the rates without fearing the consequences too much. So what explains the Fed's inaction?
No, that's certainly true. Many corporations are sitting on large amounts of cash. So liquidity is not the key problem. The difficulty here again is that while there are big corporations that have a lot of cash reserves that they are not investing, there are many small and medium enterprises, even in the US, that are finding it difficult to get credit and financing from even a broader set of financial markets. So you have this dichotomy between the large corporations and the small corporations, and the small corporations tend to be much better in terms of generating employment growth. So here again, the Fed faces this conundrum that liquidity doesn't seem to be the problem on average, but for the small firms, credit conditions are still very tight. So an increase in interest rates at this stage might end up hurting those firms that potentially could be the ones generating more employment growth, generating more investment.
Rakesh, the US Fed has become the de facto central bank for the rest of the world. So how much should we in India fear a Fed rate hike? Will it impact investment sentiment adversely at a time when it's not very healthy to begin with?
The time now is really for a fiscal stimulus. You also have influential thinkers and columnists like Larry Summers arguing very, very strongly that this is a perfect timing for for the developed countries in the world to, given somewhat negative interest rates or zero interest rates or near zero interest rates on long-term bonds in their countries, for the government to actually raise money through bond flotations and then invest those resources into infrastructure, because one can even observe, one can certainly observe in the United States that a good deal of their infrastructure is in need of reinvestment, refurbishment, and also new investment. The airports, roads, ports, bridges, there's a huge amount of infrastructure investment we've done in the United States, and also what one hears about Germany and other countries in Europe, they are in a somewhat similar situation. So that's a long way of saying that, well, yes, there's some global signals coming, that there could be greater fiscal stimulus, greater public expenditure on infrastructure coming in our way in the next months, couple of years, whatever. And there's some signs of bond market yields of longer tenor inching upward somewhat. Now, that is by way of introduction or background to what might happen to the rest of the world if the US starts increasing interest rates, does start doing the rate increases as had been expected earlier. So one of the issues earlier was that the expectation was that there would be an increase in the short-term rate, but it would not have much transmission to the longer-term end. Now there is some expectation that if there is an increase in the short-term rate, it will also transmit itself more efficiently to the longer end, partly because of this greater expectation of government action around the world to stimulate growth through fiscal stimuli. Now, if that is the case, if that is the expectation, then a rate rise in the United States is more likely to affect the rest of the world, so that if there is a rate rise and longer term yields indeed go up as a consequence in the United States, there is more of a chance of a return of liquidity to the United States, and hence withdrawal of liquidity from the rest of the world, particularly emerging markets. Now, what does it hold for us? It does seem to me that we have enough defenses against this. Our foreign exchange reserves are healthy, but I think that it will need active monitoring and active action to be prepared for this eventuality, so that we reduce the negative impact of such a rise on our own economy, and continue with the investment promotion activities within the country.
Ishwar, what to your mind weighs more with the Fed, external or domestic factors? On the external front, we now have much fewer worries than before. So what is really the biggest worry for the Fed at the moment?
The external factors is certainly one element of the Fed's decision-making process, although it's still largely driven by domestic considerations. On the external front, we've gone through the Brexit vote, but there is a sense that the fallout of Brexit is still working its way through the system. Again, the China growth story seems to be less of a concern now, because growth in China has stabilized, although not necessarily for the right reasons. There seems to be a pickup in investment which could lead to excess capacity problems down the road. So on the external front, certainly there is some degree of calm, but this calm has underlying it a sense of enormous weakness in the rest of the world. So Japan is certainly not out of deflationary pressures. Likewise, in Europe, inflation is just a smidgen above zero, so they face deflationary risk. So there is a sense that a small shock could tip many of these economies that have very low growth, deflationary or disinflationary pressures back into very dangerous territory. And if the Fed action were to serve as a trigger for some of those actions, then the consequences for both the rest of the world and the US economy could be quite significant. So it's a factor. I don't think it's a determining factor right now, but certainly the uncertainty in the rest of the world, the weaknesses and the deflationary pressures in the rest of the world are another element that is probably causing many of the Fed committee members to rethink the notion of a Fed rate hike in September.
Well, I'm afraid I'll have to interrupt you there for a moment because it's time for us to slip into a very short break. But please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Maithili, and we're in discussion with Ishwar Prasad and Rakesh Mohan on the probabilities, the possibilities of a Fed rate hike next week, and what does that mean for the rest of the world and for India in particular. Another question, Ishwar. Poor monetary transmission has always been seen as a very much of an Indian phenomenon, but what we are seeing in the current situation is that monetary transmission is just as poor elsewhere in the US as well as in India. In the US, 10-year treasury bills, the yield on them is much lower than what it was before the Fed hiked interest rates. So is there a sense of some kind of helplessness with the Fed, and is that what's holding it back?
I wouldn't quite characterize it as helplessness, but certainly there is a degree of unpredictability here. If the Fed were to raise short-term rates, what it could end up doing is taking some money away from the equity markets and creating a flight to safety within the US economy and perhaps also from the rest of the world into the US. And where would this money go to look for safety? It would probably go into the long end of the treasury yield curve. So you might have this very perverse effect that the Fed, by raising short-term interest rates, ends up actually reducing long-term interest rates. And as you've pointed out, what has happened over the last few weeks indeed suggests that even the prospects of a Fed rate hike tightening brought down the 10-year bond yield in the US. And again, the US is hardly special in this context. Japan has been trying very hard to use aggressive monetary policy to weaken the yen. But a couple of months ago, when the Bank of Japan sent a very strong signal that it was going to take additional monetary policy actions, if anything, that ended up strengthening the yen, undoing all that the Bank of Japan was trying to do. So the difficulty facing the Fed and other major central banks is exactly what you've pointed out. Given the actions that they took during and after the financial crisis and the channels they relied on, the standard transmissions of monetary policy transmission are not working well at all. In this low interest rate environment, investment should be somewhat high, and that effect on domestic demand doesn't seem to be showing up in any of these economies. So the transmission from monetary policy to interest rates and other financial market variables and then to real economic activity is anybody's guess at this stage. And I think the traditional models, traditional relationships don't work anymore. So a lot of monetary policy actions are seat of the pants actions these days.
Rakesh, would you agree that poor monetary transmission is now a global issue, and there seem to be very few remedies to that?
Yes, that indeed is, I think, engaging the attention of central bankers around the world. With all the actions that have been taken since 2008, both in terms of reduction of interest rates as well as the different kinds of quantitative easing, QE 1, 2, 3 and so on. Also the other instrument, that is forward guidance, that has not resulted in the kind of stimulus to economic growth that had been expected. So there's a great deal of discussion going on why that is so. Has the equilibrium rate or the neutral rate of the real interest rate come down? There does seem to be a good deal of evidence that whereas through the 70s, 80s, perhaps till the mid-90s, we might have thought of 3% real interest rate as a neutral interest rate in the developed world and the rest of the world, that maybe that has come down to 1%. Second, there is certain degree of, the good amount of work, particularly by Robert Gordon in a recent book of his, which is basically saying that productivity growth has really slowed down in the world, in the US in particular, but in the rest of the world as well, which of course then translates into expectation of lower growth because of lower productivity change. Third, the demographic change is going on with aging in Western societies, particularly in Europe and Japan, less so in the United States because of its more positive immigration policies, so that the demographic change in the US is less than in Europe, Western Europe and Japan. So again, that is putting a downward pressure on growth rates and savings rates and so on. There are a number of developments taking place in the world which are having the effect of lowering the expected growth in the future, and therefore as a consequence the impact of monetary policy in acting as a stimulus for promoting growth has indeed come down significantly. And so yes, this is indeed engaging the attention of central bankers and economists. So in some recent writings, in some recent conferences, and some recent discussions, they're also talking about now increasing the inflation targets from what has been agreed for quite some time of 2% to something like 4%. Because if you increase inflation target of 4%, the nominal interest rate, suppose you have a neutral real interest rate of 1%, then the nominal interest rate can be 5%. And if there's a crisis in the future, there'll be more room for central banks to stimulate economies by reducing the nominal interest rate further than is possible with a 2% inflation target. So these discussions are going on, and obviously, as in most things, such things are no clear answers.
Ishwar, I know I have asked you this question at one of our earlier interactions, and you've always held that the Fed is independent, etc. So the impending US elections will make no difference at all. But surely it would take a brave chairman to raise rates just before the election in November, in which case a rate hike can only happen in December. Would you agree?
I think a September rate hike is unlikely. It's unlikely because the economic data are not that clear, and as you've correctly pointed out, with the presidential elections coming up on November 4th, any action that the Fed takes, and indeed even if it doesn't take any action, it is going to be seen through a political lens. But especially if it were to take action right now, and that were to create turmoil in financial markets in the US and perhaps in markets around the world, that would cast undue attention on the Fed. So given that the data don't make a very strong case, and I mean specifically the inflation and wage growth data, since those don't make a strong case by themselves for an interest rate hike right now, my feeling is that the Fed is likely to punt this at least till December and wait for a couple more months of data and till the heat of the political season is over here in Washington.
Rakesh, how much do you think political considerations weigh with central banks, including our own Reserve Bank of India?
Well, in principle, of course, central banks have been aggressively promoting, advocating the independence from governments. In principle, they should not be influenced by short-term political developments. I would, I think, say that the US Federal Reserve has not shown any inclination towards being influenced by political developments. But here also what is interesting is that for the first time in this campaign, Donald Trump came out with a very clear speech, I think it was yesterday or day before yesterday, where he said he accused the Federal Reserve Chair, Janet Yellen, of not raising interest rates so that the Democratic current administration is helped towards the election of their candidate in this election, Hillary Clinton. I doubt if Janet Yellen would be swayed by this argument. But yes, the campaign has now injected a certain degree of political discussion in the firmament in the United States on this issue, which was absent before. The current expectation, of course, for the September 21 decision, current expectation for next week's decision is indeed that there will not be a rate increase. There was a speech by Lael Brainerd on Monday. She is regarded as among the doves on the FOMC, and she gave various reasons for why it would not be the appropriate time. One I mentioned before, that is, there's still no, it cannot be confidently expected that inflation is moving up to the target rate of 2%. There is no evidence of the lower unemployment causing any inflationary pressures. That is, the Phillips curve is absent. There are expectations of further employment gains without any inflationary pressures. She's also observed that there's global weakness in the economy around the world, and therefore, again, not a good reason for doing a rate increase in this coming meeting. And he's also cognizant of the sensitivity of the dollar to rate increases, particularly in the presence of negative interest rates in Japan and the United States. So that if you raise, one of the problems that the Fed has in taking a decision to do a rate increase in the near future is that given the negative interest rates in Japan and Europe, that any increase in the US rate will indeed attract liquidity coming this way, a dollar appreciating, which again would then put a dampener both in inflation as well as US growth in the coming months and years. And therefore, the US Fed is indeed in a very, very difficult position on how to chart the coming months.
Well, I'm afraid we've run out of time completely, so I'll have to end this discussion here. Clearly, as of now, the odds seem to be against a Fed rate hike later this month. But all that means is that we've postponed the inevitable. Indeed, the Fed has time and again chickened out and in the process is just postponed the day of reckoning. Will the price be too high? We'll have to wait and see. Thank you, Ishwar and Rakesh, for joining me in this discussion. Thank you also for watching. Remember, we'll be back next week with yet another edition of Macros with Maithili. Till then, it's thank you and goodbye from all of us at ET Now.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.